The market is walking into a week that can honestly slap your portfolio around a little if you're not paying attention. Nvidia earnings, Jackson Hole, and rising yields are all colliding at the same time. And when those three start talking, stocks do not stay calm for long. So the real question is simple. Is this just another noisy week? Or is this the moment the market tells us what comes next for AI, rates, and your money? Hey, I'm William, and if you care about making smarter moves with your cash, instead of just doom-scrolling market drama, you're in the right place. I break down the news that actually matters, what it means for stocks and your wallet, and where the traps are hiding before everybody else notices them. Let's start with the big one, because there's no polite way to say this. Nvidia is still the heartbeat of the AI trade. When Nvidia reports, it's not just one company updating investors. It's the market checking the pulse of the entire AI boom. Are hyperscalers still spending like crazy? Are customers still lining up? Is demand cooling? Or is it somehow still accelerating? That's what everyone wants to know. And now there's an extra twist. Bloomberg reported that Nvidia has warned some of its biggest customers that servers containing its AI chips could cost more than 15% higher. That matters way beyond one product line. Why? Because if the king of AI hardware is raising prices, that can feed straight into the inflation conversation. And when inflation gets sticky again, bond yields can jump, growth stocks can get hit, and suddenly the market starts acting like it forgot how to breathe. That's the part people miss. Nvidia isn't just an AI stock anymore. It's become a market signal. If the numbers are strong, the bulls will say the AI build-out is still in overdrive. If the guidance is softer, the bears will immediately start whispering that the easy money in AI is over. And if pricing is rising, investors have to ask a very uncomfortable question. Are these AI gains coming with a bigger inflation bill attached?
Now, let's talk about the other giant shadow over the week, Jackson Hole. This is where markets start listening for clues from the Fed, and that can move everything from Treasury yields to growth stocks to dividend names. Investors are already on edge because the bond market has been rattling stocks lately. When yields rise, the valuation math gets harsher. Future earnings suddenly look less exciting, especially for high multiple tech names that were built on the promise of growth far into the future. So what happens when you combine Nvidia earnings with Jackson Hole? You get a market that is trying to price two different realities at once. One says AI is still the strongest trade on the board. The other says the Fed may still have a say in whether that trade keeps running. That tension is exactly why this week feels choppy. Not broken, choppy. There's a difference. Choppy markets are where strong hands get tested and weak hands get shaken out. And if you're wondering where the bond market fits into all this, here's the blunt version. Yields have been bossing stocks around again. CNBC pointed out that rising yields rattled the market this week. And honestly, that's the kind of headline that should make every investor sit up a little straighter. Because when yields climb, the whole market recalibrates. Cash suddenly looks better. Bonds compete harder with stocks. And anything priced for perfection gets a little less perfect. That's why the next move in yields matters so much for regular investors. If you own growth stocks, especially AI names, rising yields can compress valuations fast. If you own dividend stocks, higher yields in the bond market can change the way investors compare income options. And if you're just trying to build wealth without getting steamrolled, this is the kind of backdrop where discipline beats excitement. Now, speaking of income, let's shift to the dividend side of the story. There's a reason investors keep circling high-yield dividend stocks right now. When the market gets messy, income starts looking a lot more attractive. A good dividend can give you cash flow while you wait, and that matters when stocks are swinging around like they had 3 espressos and bad news in the same morning. But here's the catch, and I want to be very clear about this. A high yield is not automatically a good yield. Sometimes a stock yields a lot because the business is strong and returning capital to shareholders. Sometimes it yields a lot because the market thinks the business is in trouble and the stock price got crushed. Those are not the same thing, not even close. So when you see a list of favorite high-yield dividend stocks, the real question is not how big is the yield. It's, can the company actually keep paying it? And better yet, grow it. That's where investors can separate income from illusion. A solid dividend stock should have real cash flow, a business model that can survive a rough patch, and enough balance sheet strength to keep paying when the economy gets weird. And in this market, weird is not exactly in short supply.
That brings us back to the broader theme tying all these stories together. Rates are still the invisible hand on the wheel. Nvidia is still the headline magnet for AI. And dividends are becoming more interesting because investors want something that doesn't depend entirely on multiple expansion and hype. That's why this week is so important. It's not just about whether one stock beats earnings. It's about whether the market can keep believing in expensive growth while yields keep reminding everyone that money is not free. Now, let's zoom in on the Nvidia pricing news for a second, because this could be one of those stories that sounds small at first and then turns out to matter a lot. If Nvidia's AI servers are getting more expensive, that pressure doesn't stop at Nvidia's own customers. It can ripple outward into data center budgets, cloud spending plans, and the economics of AI deployment.
In plain English, the cost of building the AI future may be rising faster than people expected. And if that's true, then the market has to decide whether the AI boom is still expanding cleanly or whether some companies are going to feel the squeeze between higher costs and investor expectations. That's where things can get spicy, because the market loves AI growth, but it hates surprises, especially expensive ones. So what should you actually do with all this information? First, don't chase every green candle just because Nvidia is in the spotlight. The market can absolutely rip higher on a great report, but if yields keep climbing or Jackson Hole sounds hawkish, those gains can get faded fast. Second, if you're holding AI stocks, pay attention to guidance, margins, and customer demand, not just the headline revenue number. Third, if you're looking for stability, dividend stocks can make sense, but only if the payout is backed by real business strength. That's the practical piece most people skip. In a week like this, you don't need to predict every move. You need to understand the forces. Nvidia tells you how hot AI really is. Jackson Hole tells you whether the Fed is about to change the mood. Yields tell you how much valuation pressure the market can tolerate. Put those together, and you've got the actual map. And here's the part I'd keep in the back of my mind. When the market gets this conflicted, the biggest winners are usually the investors who stay selective. Not frantic, selective. That means knowing when to own growth, when to lean into income, and when to sit on your hands instead of forcing a trade because the timeline is loud. So yes, this week has big event risk. Yes, Nvidia can move the whole AI complex. Yes, Jackson Hole can shift the rate narrative. And yes, rising yields can keep shaking the market if the bond market decides to stay dramatic. But that also means there will be opportunities hiding in the noise for investors who know where to look.
If you want the cleanest summary, here it is. This is a market test. Not just for Nvidia, not just for the Fed, for the whole idea that AI can keep carrying stocks while yields keep pressuring valuations. If the market passes that test, the rally has room. If it doesn't, expect more chop, more rotation, and a lot more second guessing. And honestly, that's where the money gets made, if you stay calm. I'm William, and I'll say it plainly. The next few sessions could tell us a lot more about where stocks are headed than the last few weeks did. So keep your eyes on Nvidia, keep one eye on yields, and don't let the market trick you into confusing noise for direction.